Call the investment committee back to order. Do I have to close closed session or no? Our closed session.
Just come back into open.
We're coming back
And
into,
report any action that you took in closed session, which was none.
okay. I think you just gave my report for me, Brian, so
I'm sorry about the mint in my mouth.
that's okay. That's okay. So we're coming back into open session, nothing to
Good idea. I
report.
have some in my pocket.
So we're starting with item 2. Did we already approve? Oh, I'm sorry. Did we approve the committee agenda and work plan? I don't think we did do that because
No.
we thought we were going to do it yesterday. So let's start with item 1, approval of the committee. Oh, I'm sorry. Okay.
Move approval?
All those in favor say aye.
Aye.
Opposed? Abstentions? Do we need to take roll call? Or did we? Okay. Okay. All right. It's all these moving parts. So item 2, Alan, semi-annual performance reports.
Madam Chair, members, Alan Emkin, PCA, with the year-end 2013 performance report. There are many, many pages. I will not go through many, many pages.
Bless you.
If you go to page INV 13, provides you with 2 tables. One compares the portfolio's performance to the policy benchmark and the other to the median fund. What we try to focus in on is the difference between the policy and the portfolio. And for the 1-year period, you beat the policy by 20 basis points, but the most startling fact in the report is an annual return of 19.1%. Over 5 years, the portfolio has generated a return of 11.2%. That's significantly above historical averages, and my job is to give you perspective. It is unlikely that that will continue. I don't know when that type of performance will cease. I'm very grateful that it occurred, and I'm happy for you and the members. But one should not forecast based upon the recent past. There's no evidence that there's any linkage. And being prepared for something other than such outstanding performance is important. Relative to your peers, you have significantly exceeded the performance of your peers over all periods, with one exception, that's 5 years. And that was primarily because of one asset class's significant underperformance in the 5-year period. But that's outstanding. Relative to other large financial institutions, you've done quite well. If you go to INV 15, we do these risk reports on a regular basis. And the key here is for us to give you our opinions on where the risks are. Using our metrics, U.S. equity is fully priced, real estate is fully priced, private equity is getting there, and unfortunately, with the exception of emerging market equity, nothing looks cheap, which means it's more difficult for your staff to find places to allocate money that have the potential to generate superior returns. The bottom table on that page looks at some other metrics, and considering how fully priced the equity markets are, risk is measured by the VIX index is near historical lows, so there's a disconnect between risk in the marketplace and valuations. Short-term interest rates have been held very low, not just United States, but globally by central banks. Long-term interest rates have increased slightly. The belief is, and I don't know when, interest rates at some point will rise. When that happens, the value of bonds goes down. Your portfolio with intermediate duration is well positioned not to suffer too badly in that environment. If you go to INV 50, that provides historical asset allocation. Asset allocation will determine 90% or more of the risk and the return of the investment portfolio. And what's happened over the last 5 years is that your equity exposure has increased, fixed income has decreased, and the allocation to private markets, real estate, and private equity has increased. That is not unusual. Most of your peers have done something similar, and when interest rates are as low as they are, it's not unreasonable to not have reduced the exposure to that asset class. But since real estate and private equity are linked in no insignificant part to the equity markets, a very, very large percentage of your portfolio will move in tandem with the equity markets. And once again, since we've gone through such a really good period of time, which you fully participated in, you just need to be cognizant of the fact that in the event that there is a sell-off on the equity market, it will at some point impact the real estate market and at some point impact the private equity market. INV 51 is what we call an attribution table analysis. Where did you add or lose value in terms of both asset allocation and selection within an asset class? And there's one number that really deserves attention, and that is the private equity number. And you can see over 6 months, that was the largest single factor with a negative sign. And that's because of the disconnect between a benchmark, which is based on public markets, and the underlying assets being appraisal-based. And so in rapidly rising markets, using this metric, you're going to underperform. In falling markets, you should have superior performance. Over the long term, it turns out that it's a really very, very good metric. In the short term, it creates really not very good information. That's why it's important to point it out. The same thing is true, but even to a larger extent on INV 52, which is the 1 year. In fact, pardon me?
Hang on 1 second, I have a question from Paul.
Oh, okay.
Yeah, just back on 51.
Sure.
So if I understand this, then down in the bottom right, so the returns were 6 basis points less than we would have expected if we had been weighted according to our asset classes, 12 basis points better than the index within each asset class. And then I'm not sure what the -8 basis points is on timing, and so the aggregate impact is basically 1 basis point less than had we been properly weighted exactly at the policy.
Right.
And
Exactly.
and so what is the timing, the 8 basis
That's
point?
basically, that's just movements among the asset classes, which is impossible for us to measure. So it's the minor changes that go on within the portfolios between the time periods. And it's the residual. We can figure out everything else, and everything else falls into timing.
Great, thanks. Okay.
Does
Thanks.
that-
Just explain. Thank you.
But the key there is to recognize that each one of the asset classes within its asset class did well over most periods, with the exception of private equity. And the reason private equity didn't do well wasn't because your staff didn't do a good job, it's because of benchmark misspecification. So all in all, to make it a very long story short, you've had a great run. Last year, relative to your peers, relative to corporates, endowments, everyone, you had excellent performance. It's just important to keep in mind that if you could have really, really good performance, which is driven by investment characteristics, those same investment characteristics can be out of favor And so if you can be at the 10th decile, you can also be at the 90th decile. And it's just important to keep that in mind. And I'm happy to answer any questions that the committee may have.
Any other questions from the committee? Seeing none? Thank you, Alan.
Thank you.
Appreciate it. Great. Michael N.
With Michael's come up, if I can just share one thing in this report, I'd encourage you to flip through particularly the major public asset classes, U.S. equity, non-U.S. equity, fixed income. I want to do a shout out to those asset classes because one of the things I'm most proud of, it doesn't happen every time period, but if you read in PCA's notes, our 5 largest allocations in each of those portfolios, for this time period, they all outperformed their benchmark over the 3-year period. So where the bulk of the assets were, the staff's making the hardest decisions, those allocations beat their benchmark. And that's a big part of what attributed to the positive results Alan's bringing up. Oh, I have it right here, sorry.
Okay, I'm going to go through this quickly. Michael McGee with the Townsend Group for your third quarter 2013 performance. We've changed the format of the report. There's as many pages as there used to be. We've just kind of shuffled things around. So if you're looking for something in particular, please feel free to reach out to me. I'll tell you where we've relocated it. Trying to really just be very focused on the macro level when we present the quarterly reports. On a funded basis, the CalSTRS program was at 12.4 as of the end of the third quarter. That was relative to the 12% target that was then at that time in place. It has since been changed to 13, and so we're just showing the new asset allocation and what that means to your target, given the current funding at that point in time. From a return perspective, what I want to focus on, this is INV 125 in your books. I really just want to focus on the difference between the long and the short term. In the 1 quarter and the 1 year period, we're beginning to see both the market recovery and the impact of changing your index to a levered index, which is more consistent with your portfolio. So when you look at that 3, 5, and 10-year return, you're still comparing a very highly levered portfolio to an unlevered benchmark and in a down market. So there is very little expectation that you would be able to beat that benchmark. We'll see those periods roll off as we move forward, and the bright side is that on a go-forward basis, we're continuing to outpace the benchmark, even with adjusted leverage and the additional that risk that implies. We're still outpacing the benchmark going forward. On INV 126, just highlighting part of what's creating this pattern. The dark blue line are the investments you have made since 2010, which is when we had capital available to us. The denominator had recovered sufficiently to allow for real estate investments to begin taking place. And you can see in those dark blue bars that the selection that has taken place in those periods has been very strong, and you've outperformed the relative benchmarks, and that includes over the 3-year, including the NPI, which would have been your old benchmark. So really good, strong selection and portfolio management from your staff since 2010. On page 127, just looking at your portfolio diversification, this is to address the board's decision to go more towards core. As I indicated in closed session, your core portfolio has increased in its exposure significantly. Your staff's been very active in making investments there, as well as selling assets in your non-core area and transferring those stabilized assets to your core portfolio. The opportunistic bucket remains out of compliance. It was a huge portion of your portfolio. Great strides have been made, but it's going to take us a little while to get there. Everything else was within range. The next page, INV 128, shows that by the first quarter of 2015, we expect that core will be at the 50%, and the rest of your portfolio will be well within ranges that we're comfortable with. That will likely, what will not occur is that we will not likely be at the 13% target. Again, that's because of pricing as well as the fact that the target is new. We wouldn't expect to get to that increased target in a short period of time. We'll do it over time prudently.
Michael, can I ask you about that opportunistic bucket? And I mean, I look on the next page on 127, and it looks like, if I'm reading it right, we're moving to 35% in 2015. I mean, when when do you anticipate us getting into compliance? Because our current target's 30%, correct? And sort of, I guess, wonder if you could talk about how do we get there? What's the process?
Yeah, the challenge with getting there is that you have two ways of getting there. Selling your opportunistic real estate, which for this portfolio is a bit of a challenge because most of that is in locked up, closed-end limited partnerships. They've sold the ones that the assets and portfolios that can be sold that aren't expected to garner any go-forward returns. But really what you have in your portfolio now are funds you can't get liquidity out of, or those that we believe on a go-forward basis will actually provide you with an opportunistic return or a good risk-adjusted return. So there's very little to do other than to allocate to the core and value in order to, by relative weighting, rebalance the opportunistic. We are getting to, I would agree with Mr. Emkin, that we are at what we would call full pricing. We look more for price to perfection as a concern, and price to perfection meaning that they're making great assumptions that are not likely to occur or bring with them some significant risk in order to keep the returns where they are. So when you're at a fully valued market, it's hard to make acquisitions and feel like you're putting your dollars into the best place. So it'll be a challenge going forward from 2015 forward. I will remind those of you that have been on the board for a while, when we originally changed to the core, which is just 6 years ago, we expected this could take us 10 years. So we're ahead of schedule. Mm-hmm. We're just not there yet. Okay. But we want to get there prudently, and everything that can be done is being done without cutting off your nose to spite your face. We will not force it to 30% just to get to 30%. Right. By either divestment or investment in lower risk.
Right, got it, thanks.
I know I always do this. I'm going to skip the market overview. I'm going to skip it for two reasons. The slides that are in your presentation are really good, effective summaries, and I was just going to highlight bullets on those. We are looking for an opportunity, and I'll be working with Ms. Hendricks to work on an opportunity to get the full view of the world in front of the investment committee. And it won't change between now and when we do it, so I will defer to the board if you have any questions. Pardon? Yes, it should, hopefully. All right, thank you.
Mike Moy from PCA. If you go to INV 219, you will see the depiction of performance of the private equity program. You'll notice in the italicized area, the differentials between the custom benchmark and the actual performance. It's being negative for 4 of the periods presented, but since inception, it's outperformed by 110 basis points. Versus the private equity industry benchmark, which is the State Street Private Edge numbers, you're kind of right on target with what they're doing. And this goes to the conversation we had earlier as it relates to looking public markets versus private markets. I think when you look at it on an absolute basis and you go back to the numbers that you saw in the general presentation, private equity has been the most consistent outperforming asset class and has contributed to the success that you've had. Just from an informational perspective, in the introduction to this table, you'll notice that there's 323 active investments across 124 firms. So you have what I would say is a reasonably concentrated portfolio. Others have much larger numbers. You do not, which from a managerial perspective and an investment perspective, I think is closer to optimal than not. Flipping forward, you'll see that you're heavily concentrated in the buyout space, and that's purely an issue of being able to deploy capital. You've benefited from it in terms of the performance it's turned in. You're tilting away from the mega space and you're going down to the middle market space, which is good. Whether it's going to continue in that respect, is, I think, arguable by some that at some point in time, the mega space will return in terms of a place to be, because even though the inefficiencies appear to have been extracted from that sector, I think there's arguments that there are others out there that are contributing to the return of inefficiencies. Cash flows on INV 225, you're in the position that most of the large public pension fund investors in the private equity space, you've been cash flow positive the last 3 years, $7 billion over a 3-year period of time cumulatively. You'll notice that the distribution have been climbing steadily, and unfortunately the contributions, which is effectively the financing of new investments by the managers, has been contracting. It has not been going up as quickly. What's happening, this is a time in the marketplace for everyone to be selling. Most people are. So that's the dynamic that results. There's $900 billion to $1 trillion of unfunded commitments out there, and how that's going to get deployed over the next 3 years is a big question mark in the industry. But I think it's a function of what's happened in the capital markets. From a vintage year performance, which is the way most people look at private equity performance, there's a chart on page 226, and you can see the dot where STRS is ranked in each of the years, and that's kind of the way people look to see, did you make first quartile selections that in that vintage year or not? You'll notice that back in 92, 93, 94, top quartile will seem to be the prevalent arena. You experienced it again in 2000 and 2001, and you've been mostly in the second quartile, but your performance numbers in the aggregate compare very favorably to other large investors. Page 229, the investment vehicles. Most of your returns have been, since inception, have been coming from commitments that you've made to partnerships, to funds managed by others. Co-investments have been producing a rate of return that's not quite half of what you've gotten out of fund investments. That is not optimal, because when you do co-investments, you typically don't pay any fee or carry on them, so you would expect to be being positively influenced by that, but it doesn't come through in these numbers. And it points out the difficulty of doing successfully co-investments, because you run into the issue of adverse selection when you look at transactions. But having said that, more and more people are getting into co-investments because it is a way of influencing the cost of a program. If you flip forward to page 233, you'll see the proactive portfolio. We've talked about this as long as I've been the consultant to the investment committee. The IRR, lower right-hand corner, is 1.9%. That's not exactly what you were seeking when you got into it. You've got now, you're going to have 3 fund of funds sort of concentrating on getting that number to come up, and it's something that staff and the consultants will continue to watch. If you go to 236 and 237, you'll see new commitments that have been made. You've had a pretty active time period. Lots of commitments have been made, which is an attempt to keep the vintage year exposure that you're getting up to par for the program level. Having said that, I'll be happy to answer any questions. You're welcome.
Catch up with you. So this is the assets for the fund. At the month, March 31st close, it's unreconciled and not audited, so I want to be clear to everybody. But especially for the teachers in the back, the question came up at the Client Advisory Committee, that is a close, basically at our all-time high. I'm going to encourage people not to get stuck on focusing on all-time highs, because with our negative cash flow, we're swimming into a very strong river current. So we may make successive new highs, but they're going to be very small. You can see the growth so far in this current fiscal year. So I would consider this your three-quarter poll as we pass through the year. We just have 3 months left in the year, and as we've discussed, the asset allocation for the plan. This is our asset allocation versus targets, and as we discussed, we're actually fairly tight. The global equity overweight is offset by the private equity underweight, and as we discussed earlier, when you add these up, they're fairly tight. The one under allocation or underweighting is into fixed income, but each of the asset categories is pretty close to its stage, and as Michelle presented to you, the TAC, we're constantly evaluating that and looking at it. This is a chart of the equity market so far at the three-quarter mark. As you can see, it's been a steady ride up. We've had some downturns and some tough times. What's amazing to people is, and this is June 30 to March 31st, so picking up the last half of 13, the beginning of 14, we are up about 17% in the S&P 500 year to date. And I haven't seen where the market is today, but yesterday, obviously, you heard that we closed at record highs, or day before. So we are seeing the point where the market is well back above where it hit previously in 2008. So going up the crow's nest and looking out into the future of what are some of the concerns out there, they remain the same. Obviously, I did not foresee Crimea and Ukraine, so fell a little short on that one. Who knows what the next one's going to be, but we're going to continue to look at the global risks. On the positive side, as I've said many times before, we don't want to fight the Fed. They're continuing economic stimulus, and I want to go through a little bit of a report on that to go into a discussion. And I'll turn it to one more slide. One other thing I do want to point out, people have brought up yesterday or day before, it came up kind of at the end at the client advisory as they were leaving the room. And I have not yet seen it. The 60 Minutes episode talked about high-frequency trading. I wanted you to know high-frequency trading is something we took a strong look at about 2 years ago. And the Global Equity team actually produced a white paper 18 months ago, which I'm not sure if I sent to the board back then, but we can resend it, where they took a deeper dive into high-frequency trading. And I know we talk a lot about a lot of things on this list, but we actually had algorithmic trading and high-frequency trading on this list a year and a half ago, if you went back and looked at it. So this committee did talk about that as a risk in the markets. We didn't go into a deeper dive. We felt that it was there, but it was not going to be as significant as some of these other risks, so we removed it from that. But to credit the committee and to STRS, we do think about these things well ahead of the time before 60 Minutes finally gets to them. High-frequency trading, or dark pools, as they are called, certainly it's good that the federal regulators are finally going to take a look at them. We have had numerous discussions. We actually had a conference call with a former chair of the SEC who's on a board of one of the high-frequency trading firms. They do create liquidity in the market. I would still question their social value, about whether they do any social good into the market. They're adamant that they do. But their algorithms are generally based on the same math, even though they're all done independently. And there's some interesting articles about people stealing the algorithms and how they're doing, and all of the questions in the shows. And I guess the New York Times questioning it. I do not feel the market's manipulated. I don't feel that it's, say, a rigged set against us. We want liquidity in the market. We have questioned the value of trading within the fraction of a second. As I said, they feel that adds liquidity to the market. We like decimalization and the process, but we're not sure that they're an evil or something that should be regulated. We're going to leave that to the SEC and to the government to decide if those things should exist or not. They do not, we don't trade with them and they don't directly impact us. They're just part of the market. The one thing I would say is this role was always played at the New York Stock Exchange, but in the old days it was the floor brokers. And you can go way, way back, it was the runners between the traders and the people on the floors. So these are the way markets function. And with technology, they're getting more advanced. So to my last point, I really wanted to take some time and I guess take your time to plant a flag. I really feel that I think we want to make note of this April meeting in 2014. As Alan said earlier, we've been on and I like word pictures. I tried to produce this the way Joe Deere would as a tribute to him, but I can't be Joe Deere. I have to do it my way. Which is a word picture. Think of it as that we've been driving in this U.S. economy car. It's been a nice downhill trend. Sun's at our back and everything's going our way. The Federal Reserve's been driving the car and they've had their foot on the gas pedal. And it's been great. As Alan said, we earned 19% last year. But as he also pointed out, that can't continue. So the U.S. economy has been doing better. The Fed has been easing off the foot off that gas pedal by about $10 billion a month, which we've called the tapering, to back off of quantitative easing. That should end in about October. Why is today significant? I would say that in March we had the new chair of the Federal Reserve, Janet Yellen, hold her first FOMC meeting and also hold her first press conference. The Federal Reserve's forward guidance has always been they wanted to get unemployment down below 6.5%. We now stand at about 6.7%. She changed that policy guidance, and even though the language is very technical, the wording is very significant, and I want to make sure I quote it correctly. They changed it away from a hard 6.5% target to, as they said, and I quote, they would take into account a wide range of expectations and reading on financial developments. So they replaced the 6.5% with what they call qualitative guidance. So qualitative guidance means we have to talk to you about more stats than just initial unemployment or unemployment claims. I think what's interesting is they needed to back away because I think you'll see statistics about today's jobs report that there are now as many jobs in the U.S. as there were in 2008. There are more people employed than there were before, but I don't think anybody feels very good about it because the U6 unemployment, in other words, the long-term unemployed, still represent about 12, or the underemployed still represent about 12%, rather than the 6.7% that was the headline number today. And the number of people in temporary jobs is up as double the rate that it was in 2008. Now, some of those temporary jobs may be for multiple reasons, but in many cases they're because people took a temporary job because they couldn't find permanent work and they would like to leave that and go to permanent work. So the Federal Reserve is going to ease off. The next day at the press conference, Chairman Yellen was asked very poignantly by what has been characterized as a fairly rude Reuters reporter, when the Fed eases off, what is going to be the time period? They had said that it would be a considerable time. And in my word picture, they're easing off that gas pedal. What we care about is when are they going to touch the brake? That's when, as Alan has pointed out, our worlds begin to change and the nice, easy time disappears. Chairman Yellen kind of went through a number of issues, but, and again, just to quote her, she said, "It's hard to define, but it probably means something on the order of around 6 months. So what did the stock market do? Quantitative easing ends in October. 6 months from next October, April of 2015. So this chart before you is kind of the expectations of economists of when the Federal Reserve may begin to raise interest rates. You can see, as not surprising, there is a range of expectations, but by far the majority focus in on 2015. And then on the other side, on the right side, I wanted to kind of quantify what kind of a rate is that? What are they thinking the rate will go up? And when they think about the rate increase in 2015, it's very slow and very subtle. So from a 0% Fed funds rate to something like 1, the next year something like 2, 2.5, and you can see a wider dispersion of expectations. Long term, they say the Fed funds will get to somewhere around 3 to 4%. I'm going to always refer to that as the normalization of interest rates, because that's what we would normally expect. Fed funds around 4. Based on the steepness of the yield curve, you get a 30-year bond rate around 7, 8%. That's not abnormal or abnormal for our economy, but that is a heck of a long way from where we are today. The issue with this is it's not going to happen overnight. The Fed is not going to hit the brake in April. They're going to look at the conditions dependent on what happens next year. That's a long time from now. But we're going to be focused on that. We'll be talking about it in the TAC. We'll talk about it with you as we look at the economic stats that come out in the summer and especially in the fall. Are things getting better than the Fed expected? Are they continuing on this slow path? Or potentially we're seeing inflation or things are getting worse. But you'll see us change our forecast and the portfolio based on this view that interest rates will change. What we're not expecting is a massive shift. We're not expecting the Fed to go from a funds rate of basically 0 to all the way to 4% overnight. That would create worldwide havoc in the financial markets. This also means that even in fixed income, you'll earn some return. You'll lose some capital appreciation as interest rates go up, but you earn coupon income. So it's not that fixed income investments will have a negative 25% return. But that increase in rates is the risk chart that PCA shows you and we provide you on a regular basis, on a monthly basis. That's why interest rates are at an extreme risk. You've heard me say it before. We're at a 250-year low in interest rates in the U.S., a 350-year low in the UK. And that's why, as Alan says, that's got to change. Rates aren't going to go lower. They will head higher. And the question everyone's going to focus on from now, we have a whole year for Wall Street to worry about this. When is the date that rates start to move? And when they do, even when they do, that's not a catastrophe. What's quite interesting is when rates start to rise a little bit, typically equity investments actually do okay. There will be volatility and there will be shocks. As Michelle said, the volatility level is very low, so we are expecting more volatility coming next summer and fall, but not some kind of a significant sell-off. The ECB, the European Central Bank, the Bank of England, and the Bank of Japan have already started to ease off that gas pedal, and some of them, ECB, has actually started to put their foot on the brake a little bit in Europe, and those markets haven't collapsed. One last thing to think about, and especially for the retired teachers in the back, for the last 6 years, their CDs have earned 0, and most of them are living on a fixed rate interest and counting on CDs to make an income. This will actually be good news to the aging population, is they might actually earn interest on their money for the first time. And so there are some slight economic benefits that will go along with this. It will not mean an economic problem. And the Fed won't touch the brake unless the economy is strong enough to handle it. So please try and remember this date. We'll talk about it a lot looking forward, and we'll revise this forecast as we move on. Are there any questions?
I don't see any questions, so we will plant the flag, Chris. Great. All right, well, let's go ahead and go on to item 12, which is approval of our minutes from February 7th, 2014. And looking at the time, let me just ask, the charter revision, Chris? Is that something?
Very fast, I would think.
Okay, so let's go to item 12.
Move approval?
Oh, they're consent items? Oh, excuse me, my bad.
Yes. They're
So
both.
so I just have to
Move
ask if we
approval.
pull it, right? Move approval? All right, all those in favor say aye.
Aye.
Opposed? Approved. So let's go ahead and do item 13, Chris, and then we'll break for
That was,
lunch.
that was also on the consent.
I'm going to ask Michelle to
you're
come
right.
forward to present it. The key change we made in your policy,
Sorry, Chris, it's consent. I didn't,
oh, never
We
mind.
just passed it.
my bad, my bad. My understanding is we just approved 12, the approval of the
I
minutes.
I
So
moved
let
both.
me make sure we're clear. So on item 12, we approve the minutes, and then item 13,
Move approval?
Second.
all those in favor say aye. Opposed? It's moved. Thank you. Thanks I need to pay attention to that consent word. So can we do item 14, Mike DeRay, in 10 minutes, you think? 8 minutes? Yes? Was that a yes or a?
Yes, we'll
Okay,
do
all
it very
right,
quickly.
all right, okay.
This is the second reading of the real estate policy originally brought in front of you. The primary reason was to adopt the Odyssey benchmark, which Michaelin talked about early in our comparisons of performance today. There was only really one significant change since the first reading, and that was the addition of the responsible contracting policy language to be referenced in the real estate policy as it is in the infrastructure policy. And with that, I'll open up to questions.
Oh, that's nice. So I appreciate the addition. Any questions
It's
from
an
Mike?
action item. We're looking for approval
Okay,
today
we're
if
looking-
the policy is acceptable.
Frank?
I had a quick question on INV 436, the core target return section. Some of that language appears to be new compared to the last version that we saw last time. Is that at all new, or is it
I'm sorry, which section?
INV 436?
Mhm.
The target return item number or bullet number 2.
Yes, and
That's new, isn't
it is new, and the changes from that were reviewed last time, they were highlighted. The essential change from the previous policy is to show net returns as opposed to gross returns.
Okay.
So the numbers are in fact the same, but we're showing the net returns to the system. And I believe in when we reviewed it last time, the changes from last time were highlighted. And I don't have a copy of that right here, but essentially it went from 7 to 9% to 6 to 8%.
My question is on the last sentence in that section. That wasn't in the last version that I saw.
Where it says target return?
Staff underwrites core investments that are expected to be held for 7 to 15 years. That line right there.
Okay, let me
Under
see.
target returns?
Yeah. I was wondering what the reason for that is. The inclusion of that language.
Michael McGee with Townsend Group. When we discussed this with the board last time, there was some confusion over
that's
the
right.
8 versus what the return should be for core, and it's just really to clarify that it's over a long term, it's an expectation, it's not a targeted return.
Thank you, guys.
Thank you.
So
Thanks
Mike,
for
is there a
clearing that
reason
up, Michael.
why that change isn't like in the track changes, like the pink?
That I don't know.
Okay.
I didn't catch that, but it should.
Because I do
probably
think,
should.
I mean, as
Should've been in
changes
the
are
track
made, it would be
changes.
Should be in the
helpful to
track
have those
changes.
in the track changes, just
We
so we
will
can
make
kind of.
sure that, yeah, I apologize. We should not have allowed that to go forward without noting that. And we'll make sure we have a reconciliation process to note all of those in the
Very
future.
nice, Frank, wow. That's detail orientation. Yeah, we are reading a lot when we read these board books, so it's just nice to be able to kind of highlight what the changes are. Thanks, Frank.
Okay.
Any other questions from board members? Otherwise, I'd entertain a motion to approve.
Move approval?
Second.
All those in favor say aye.
Aye.
Opposed? Abstentions? It passes. All right, that was quick, Mike. You get an A in my class.